Paul Hample,
Here.
Sharif,
Here.
Jody Patterson. Here. Captain Aaron Schaefer,
Here.
and Anthony Waskowitz.
Here.
I'm sorry, Milt Wilkins.
Here,
Henrietta should be joining us shortly.
okay,
And Matt Livesey might be joining us online.
all right, fine. And I'd like for Maggie to introduce her colleague.
Hello, this is John Burford from my office, and we'll be working together on some of the retirement board stuff.
Okay, very good. We have everyone here today, so we don't have to have formal apologies or anything. So let's go to the minutes from the March 20th board meeting. Are there any comments on the minutes before I entertain a motion to approve? The world has changed a lot since March of 20. I admit.
The same.
All right, may I have a motion to approve?
Second.
Okay, that was Paul and Kathy.
Thank you.
All those in favor?
Aye.
Aye. Any opposed? Abstains? Okay, fine. Now we go for the request for benefits. We'll start with the retirement benefits as usual. Civilian requests, we have 14. Becky, are there any controversies among the civilian requests for retirement benefits? All righty. May I have a motion to approve, or are there any questions?
Moved.
Seconded.
Okay, Jody and Aaron. All those in favor?
Aye.
All righty. Police requests, we have 5 for retirement benefits.
Make a motion to approve.
Second. Aaron and Paul. All in favor?
Aye.
By the way, Aaron, I'd like to ask you a question. Is the number of active duty police, is that stable or is that declining? I've been meaning to ask.
I think it's on the upward trend, actually. The
Upward
recruitment's
trend.
improving. Mhm.
Good to hear that.
Yeah,
Okay,
it is.
fine. We'll go, applications for death benefit civilian requests. We have, oh my goodness, 9 death requests and 13 beneficiaries. Any questions? May I have a motion for approval?
So moved.
Pepe, I will second. I can do that as chair. All those in favor?
Aye.
And we have 2 requests, police requests for death benefits as well.
Make a motion to approve.
Second.
Aaron and Paul. All those in favor?
Aye.
Done. Okay, fine. Now we move on to item number 4 and 4A on asset allocation strategy. I think it's reasonable, we've been through this several times, but I think it's reasonable to refresh everyone's memory on what we actually are trying to vote on. So can you give us a relatively concise overview of what we are to discuss? And I know Sharik would like to make a comment after that as well.
Yeah, all right, so what we're talking about, we have been talking about it for the last few months. It's something we revisit and want to approve every single year, but that's the strategic asset allocation for the plan. Again, when we, as we talk about over time period, our asset allocation, we're determined more than anything else, the success of the plan's investment return. And so ultimately, when we talk about asset allocation, what we're talking about is how much to equities, how much to bonds, how much to real assets, and then some of the sub dividers in there. And so we came pretty close last month. It sounded like people were kind of honing in on a specific allocation, but we did want to bring it back. I guess with some additional info to that. So with that, as long as you're good, I'm just going to highlight a few pages here.
Please.
So you have the books in front of you.
Yep.
And we'll kind of, again, if we've hit this a lot easier, just kind of skim over. But if you go to the first tab, asset allocation review, again, and we've talked a lot about this, but ultimately, really the goals of the plan, we got to keep in mind, 7.25% return. That's our discount rate. That is what the actuary uses to model our plans, investments going forward. It's return we have to keep in mind. We know we're not going to hit it every year, but ultimately the goal is to hit that, at least that on average going forward. So we do that certainly, long-term horizon, participation in up markets, but also keeping volatility in mind in the portfolio. Page 6. These are the underlying asset classes that we have in the portfolio. You know, at ACG, every single year, we call it a bottoms-up approach, but there's, you know, a lot of factors. We evaluate where we sit currently in the marketplace, look at expected earnings, look at inflation, look at income yields, look at earnings growth, to come up with, we call long, you know, intermediate term, really a 10-year expected return for each of the various asset classes. You know, it's very important. No one, obviously, we know has the crystal ball that can predict year over year, but we think we can at least get, you know, fairly close on an annualized 10-year basis where returns are. As you can see, overall, relative to last year, returns are for the most part in line, but slightly down, given, you know, particularly last year, such a strong year in the marketplace, particularly on the U.S. large cap side, up over 25%. And so all that said, what you see on page 7, so if you remember really kind of last month as we were talking about, there seemed to be a pretty decent consensus around moving 5% from our target real asset bucket over to equities. We looked at potentially moving that to fixed income, and frankly, that just didn't give us the potential return over a long period of time that we need in 7.25. So we talked about moving that to equities, and then there was a lot of talk between how do we allocate our targets between the different equity sectors, right? You think there's U.S. large cap, there's U.S. small cap, there's developed markets on the international side, there's emerging markets. And so I'll kind of hit on here in a minute, kind of where we currently are and where we would recommend, and then what some of the options show from our model. But again, just to put in perspective globally, what the opportunity set is from a weight between U.S. and international is what's on page 7. So again, what we're looking at is MSCI equity. This is the global universe for publicly traded equities. This index, comprised of thousands of different stocks, does vary over time. Its weight between those stocks, really because of the value driven by the individual companies. In other words, this is a market cap weighted index. What that means is what drives that is really the value of the underlying companies bubble up relative to each other. So what you can see and this is the last decade, it's not necessarily that the number of stocks have changed dramatically in the index, but their weight has, given the valuation. So what you can see 10 years ago of this global opportunity set, there was actually a higher weight to non-U.S. equities than U.S. equities. A little over, you know, call it 55, 45 or close. And you can see that's pretty much dramatically changed, particularly in the last 5 years. So, you know, a lot of this driven by certainly the strong performance, U.S. equities, particularly the U.S. mega cap Magnificent Seven. So where we sit at the end of 24, from 10 years ago, when we had more non-U.S. than U.S., it's actually 2/3 U.S., 1/3 non-U.S. From an allocation perspective. So how does that compare to where we are? And that's what's on page 8. So what we are looking at here on page 8 is in the top left-hand side, our equity breakdown. We do include private equity in this first allocation. Reason being it's equity for us. Our private equity exposure is pretty much all in the U.S. And frankly, it's much more kind of focused on the lower market cap side, more smaller cap than large cap. But you can see we include private equity. We're basically 60-40. This is from our target, what our current target is for all the underlying some asset classes. We're 59 U.S., 41 non-U.S. And again, is what I just kind of had showed you. The current global breakdown is 66 U.S., 34. So we're about a 6% underweight currently to U.S. equities relative to the global opportunity set. If you were to strip out private equity, that's actually even more of a haircut to U.S. equities as you could.
But logically, there's no reason to strip out.
Logically, we think of equities all as one, and we should incorporate private equity within there. And so with that, this is kind of where we settled on, or where we were discussing quite a bit on page 9 last month. So what you see is we roll all of this together. And ultimately see on the left-hand side what our current target asset allocation is, 22 to fixed income, 63 to equity, 15 to real assets. What the group's consensus seemed to be and what ACG would recommend is actually taking 5% out of real assets and reallocating that to equities.
Matter of fact, we ought to retitle that, rather than call it real assets, it's called real estate.
Real estate, what we-
That's the only thing that's been in the real assets bucket ever.
true.
If in fact, members of the board would like to come back at a later date and propose an additional an additional asset class of real assets, gold, platinum, whatever it might be, we can discuss that as possibly an additional real asset allocation. But we really have settled on 10% at this point to simply real estate.
And so, correct. And so as you see, that's our target. And then the next four columns, you can kind of see up top, 60, 40, 50, 50, 55, 45, et cetera. This is speaking to the US international breakdown in our portfolio. And so ultimately, again, we're currently, our target's 59-40. So if you think about, it's basically 60-40. So ACG's recommendation would be this first column, this 60-40, removing 5% target to real estate, and then adding that to our equity portfolio and not touching private equity target, but then allocating between the four buckets to get an overall 60 US 40 international breakdown. We know there's been a lot of discussion about valuations, and I'm sure we'll have some more of that today, but we're showing here the other breakdowns between a 50-50 US, 55 US 45, or even adding more to the last one, a 65-35, which would more closely match what the equity index is.
And that was my suggestion previously, and I've changed my mind on that, but go ahead.
Okay. And so ultimately what you kind of go down, you see some of the stats are on the bottom of the page, and then I can kind of go into more detail on the next, what the analysis shows. Ultimately, what the analysis shows from this is, again, we're setting our strategic asset allocation here. All of these mixes, from our standpoint, get us certainly in the realm and actually a higher expected return than the 7.25% that we're looking for. And then when it comes down to what's the breakdown between the actual public equity allocations, honestly, from a modeling perspective, it's very tight, right? There's not a clear kind of difference standout between these. And so really, and actually what we saw, and this is what we went through last month, the bigger change in our portfolio expectations is not so much moving from within the US, non-US, but it's more so moving 5% target out of real estate into equities. And so what leads us to the recommendation of 60-40 ultimately has to do with current valuations and expectations going forward. I showed you a few pages earlier. We do have a higher expected return for international equities than US. What is driving that is really the valuations. Is the really strong performance of US equities over the last decade, kind of hence that chart I showed you of how equity is split off and is now at 2/3 US, 1/3 non-US. So having a 60, I was quick about. So having a 60-40 with us, we still want exposure to the U.S. marketplace. Obviously the largest economy in the world. We don't want to take too drastic of a bet relative to the global opportunity set. But having a 6% underweight here to U.S., we do think tilting the portfolio that way is our recommendation.
All right. I just want to make an observation. A lot has happened since our last meeting, and it starts with the Alpha's DJT under Donald J. Trump. A lot has occurred over the last several weeks, and I'm not sure what the valuations really are, because I don't know if I can believe the E in the US or the E in the international, and I'm not sure anybody can convince anyone else that we really know what kind of environment we're going to be talking about over the next couple of years, because the tariff situation is still in a state of evolution. Next week, it may be something different. We just don't know. And so I think we just ought to be realistic about any comments that we have here, because there is a great deal of fog out there, more than the normal fog. We usually don't worry, but we usually don't have to grapple with a complete change in the international trade system. And that's a new element here. Okay, Sharif, you want comments you wanted to make as well?
I mean, I have all kinds of comments. I could go on all day, but, I'll try to, in terms of addressing this, issue we have at hand, I'd like to say that, there have been forces that have been building for a while.
Mhm.
And, I don't want to miss the forest for the tree, which is the tariff in my opinion.
Mhm.
Okay. So whether you call it short-term noise or bargaining, whatever, that is not our issue. The issue, as I've been pointing out, is the valuations. The issue I've been pointing out is the debt for a while.
Right.
And those issues are what are determining the tariff bargaining anyway. That kind of resonates with, I sent piece out from Dalio. Ray Dalio is the manager of the largest hedge fund, Bridgewater. It's not just that he manages a hedge fund. What they do is very in-depth analysis of large forces that come about. That's what differentiates them. They have a very big quant team. And what they've tried to do is see what major shifts are happening to allocate capital. And there's the key word, allocate. Allocate capital optimally. Okay. I'm concerned, and I have been concerned, as we've had a few conversations in the past, that the way we do asset allocation here is a suboptimal process. And it's not going to be able to, going in the future, in my opinion, which could be completely wrong. But in my opinion, I don't think the way we are allocating capital is going to provide good results. We've been on a great ride. We've had a great ride of $40 trillion in 2 decades. And we produced 7% in the last decade on that ride. Okay. Think of the biggest surf wave that you were sitting on, and you barely took off, is kind of the analogy. So if that being the case, I think we have to, in my opinion, revisit what we are doing here. It's not about 5% here and there. It's a.
What do you suggest specifically? Because you've been alluding to this for the last several meetings. So what specifically would you suggest we do?
So here's the question. I mean, I, included a chart in here. If you go to this, and I could have put 30 charts in here and put everybody to death. So I didn't want to put 30 charts. So I just wanted it to be one. And if you look at the second last in your package, there's one here by P.P. Morgan. Okay. What this is, and it's the most simplistic thing that I could put in with one chart. So we are at 2324 PE, which I've been alluding to and talking about for the past 6-8 months. What this chart synthesizes from that information is looking forward for the next 10 years. Historically speaking,
Yes.
Your return should be between +2 and negative on the next decade. So what we have to answer is
+2 and -2 on equities.
equities. So that being the case, okay, and we can argue about that later. That's not the point. The point is not to find the truth here, the next truth. We're not going to do that. The objective is to say, well, how are we going to, in the best of our abilities, address this, and can we, and is there a better way to address this? I don't feel that we are ready to make an asset allocation decision because in January, I mentioned that we should at least go down to a tactical, take 15% off equities, large growth equities, which was within our allocation parameters. I said at minimum, let's do that and park it into treasuries. We were not able to do that over 3 meetings. Okay, we should have been able to do that immediately. The PE ratios were 24, all valuation numbers are off the range here. I think if we can't even do that, we are kind of wasting time. I'm sorry to put it in those words, but I think we're wasting time.
Are you suggesting still reducing equities by 15%?
Well, here's the problem. We have 3 layers of management. We have it at the manager level, The manager level will never allocate. So if you give money to a large growth manager, they will always, even if they feel the valuation is completely out of line, they will still be 100% invested.
Yes.
That is what they are hired to do.
Right.
Okay. The second level is ACG. They are not making any asset allocation decisions, right? So it lies on us. Okay. If we put 80% of our time into bringing managers in, which I'm not saying that's not important at all, but those are mainly marketing pitches. Okay. They can talk about the market or whatever. Main objective again is to come and do a marketing pitch. We've all heard that all our lives, we working in this area. So if that allocation decision is going to rest on us, given the market situation, the forces that are building now, I understand you have to allocate long-term 10-year, yet we have this meeting every year. If you've allocated for 10 years, then why have the meeting? Obviously, we are supposed to go back and tweak it according to the conditions. Otherwise, we don't even have to have an annual asset allocation meeting.
Agreed. So what specifically do you recommend?
That's a very difficult question. I think we need to sit down, and I have suggested that several times. Maybe the committee members sit separately and figure out what the next steps are. Whether it could be a core and satellite kind of approach rather than follow the herd approach, which is what we do. We see what everybody's doing and say, okay, this is like the IBM approach. We want to basically, at one time, everybody was buying an IBM computer because it was the company to go to. You couldn't get fired from your job doing that. So I feel like there is a sentiment that, if we replicate what 90% of the universe is doing, then we'll be wrong with 90% of the people and we'll be safe. I don't know if that's the right approach. A core and satellite, I should mention that several times.
Why don't you define it for the board? You've mentioned it to me, but not necessarily to the entire board.
So core and satellite would work where the core is more, whether actively managed funds or S&P 500 or however you allocate, that allocation doesn't change. But it's mainly your bread and butter kind of portfolio in there, whether it's bonds, the S&P 500 index. But then there are some satellite pieces, and then the satellite pieces are where you see an opportunity. So let's say right now you see an opportunity in real assets. We can have a discussion and say, where do you allocate to that? Does that
An example would be gold,
Yeah,
as an example.
example would be
realize.
gold. Gold's outperformed S&P 500 for the past 20 years. It could be that. It could be other things. It could be.
I'm not proposing gold, although it's a good option. I'm simply for benefit of the board.
I mean, I've
simply
been
given an
doing
example.
portfolios for 20 years,
But it might
okay, including mine. So, I mean, this has been happening for a while. It's not something new. We're going to debase the currency more. So if you look at the Mar-a-Lago agreement that happened, debasing the current currency was part of it. We're going to debase ourselves out of this, and the administration's already said that is their objective. So the only positive for the market is liquidity. So if we get into trouble and we provide liquidity, we can have another way up, but don't be confused. Even if we have an up leg on the market, you're going to still debase the currency even more. Okay. So if we debase the currency, that spells against, that's why I've been against lessening the international exposure, because I think going forward, the international market will outperform the US markets this long time coming. Especially if the flows change. And the flows, I think, in my opinion, the flows are going to change. That's going to happen.
I still haven't heard specifically what you recommend.
Milt, I mean, there is not a specific recommendation, let's buy this, and be done with it. I mean, we are talking about the larger forces. We have to figure out how we're going to allocate, and it's going to be a dynamic process. There is not a solve. There's not a truth. Is we have to address how we are doing something and can we do it better. Again, under these circumstances, the pressures that are building are this again. Currency is gonna debase.
Yes, we heard that. We heard the argument. The question is, what do you do about the argument? We have to, when we leave this meeting, ACG has to know exactly what we want to do today. Now, we've been at this for 3 months. They have to know whether or not we want to do A, B, C, or D. A, B, C, and D can change over time as we refine our own strategic thinking. But we have to come to a conclusion, at least on this particular.
My
part.
opinion has not changed. If we are going forward and we have to make a decision, if you put gun to my head, I would say the equities are still not done correcting. You still need an allocation to short-term treasuries till this dust settles. I think you do not reduce exposure internationally. If anything, you increase it if you want your equity exposure to remain the same. You have a separate meeting over several, you look at real assets, see what makes sense, and you move to a portfolio, whether you take 20, 30, 40% of it in a core and satellite structure that we've talked about several times, and go against this and see after 1 or 2 or 3 years how you're performing on that. I think, again, that is a decision for the board members to
Agreed.
take on and agree, do we want this on our plate? I don't mind. Okay, somebody else may say, I don't want this on my plate. I don't want to make that allocation decision on the core and satellite. What does it mean? We have to have a separate meeting. What does it mean? Define that.
Would it be a way to look at where we would stand if we'd taken that approach 5 years ago?
I'm sorry, I don't understand.
If we had put more, a certain amount, say 20% in the treasuries.
We are not talking about that. We are not saying put 20% into treasuries. What we are talking about a core and satellite is to have some part of the portfolio where when you do the asset allocations, that you can tweak it a little bit easy. The allocation to treasuries is only now when the valuations are going crazy. Okay.
So you're talking about being able to tweak things
But
quickly.
we're not talking about a 10-year allocation, 20-year to treasury. We can talk about that. Does it make sense in long treasuries? But I mean, so for instance, on the core and satellite, again, to your point, one of the things we are talking about, and now we've heard Trump go after Powell to basically because he's not reacting fast enough, right? So they're trying to take Powell out on that basis. But it's not relevant. What's relevant is that there is immense pressure to reduce the rates. Okay. If we lower the rates, I mean, some medium or long-term treasuries may short-term perform. Are we able to, in this portfolio, take advantage of that? No, we're not. Do we want to take advantage of that? That's a separate question. Okay, and that's what we need to come to a consensus on what we want to do or what we don't want to do. If we just want to keep it like this on a 10-year allocation, 60, 40, whatever, I mean, my opinion is that's fine. You're not going to perform. That's my concern. That's my only concern.
So you're talking about being more nimble?
Yes. And that's a decision for everyone because it's not a one-person decision. Do we want to be nimble? Can we be?
The county can't be nimble the way it's structured. If you want nimbleness, is that a word? Is nimbleness a word? If you want flexibility and rapidity, you really have to give it to a third-party manager for the manager to do what needs to be done. The county can't do it just because of the approval process and even signing new documents, so on and so forth. So what I would like to have a discussion as to what we want to do today and what we can continue to think about and try to restructure for the next several months. We can do that, but what do we want to do today? What I heard from you specifically is you say today we should take, we're at 22% fixed income and you would recommend another 10 to 15% in fixed income with the expectation that will be a short-term, quote unquote, we don't know what short is, but it's not 5 years, a short-term allocation until equity valuations get to a point where it is reasonable to increase, go back and increase equities.
So large.
Is that what I hear?
So
Or
large
I
cap,
mistake?
probably we've lost, I don't know, do you have a current number since January? We've lost what, 20% on the large cap, equity side,
So we're down about through,
15, 20, 30.
we were down about 15 right after the tariff announcement in the last 2 weeks of bounced around.
So just to put that in perspective, so if we lose 15% and we would have reduced it, 15% at that time, that would have been about 15 million, I don't know, it's We could have saved ourselves 20 million bucks. I don't know. But the question is, after that correction, I cannot predict the liquidity. I think what we have to address is what solves this? I do not know what solves this. We have to come to a conclusion. I cannot sit here and say, okay, today we take 15% out today, tomorrow we put 15% on, and that's not the idea. That is not the idea. We are not doing market timing. What we have to address is, we have to come to a consensus, and I know you want a fast decision. on-
No, I want a specific
Do you want to be over and
recommendation
done with the asset
as to what
allocation?
we ought to try to do, not talk about it generally.
How do
We
you
have
plan
to
to-
operate on specifics.
That's
We
fine.
have a specific recommendation from ACG. If we don't like that recommendation, what specifically do we think is a good intermediate term, is a, not good, good is the wrong word, is a highly probable or a asset allocation over intermediate term that gives us a high probability of, a reasonably high probability of achieving our target. Target being 7.25%. Now, if we want to also, given the environment, this is like, for example, the environment would be early 2008, and we see a problem occurring, and we think we ought to withdraw some capital from the equity market because of what we see evolving in early 2008. If we want to do that as well, that's fine. We ought to consider that. Anyone else would like to add something here?
I say, I agree with what Sharif is saying in theory. And it would be really nice if we could be more agile, nimble, flexible, and react. But the reality is that we can't. And I don't think there's anything we can do to change that. The way our processes work, I don't think it's an option. Given that I don't think that's an option, I worry about those key dates. That if we depart from our current strategy significantly, if we don't have funds and equity, we may miss the next key date where we've seen historically, if you get in one day late when it's coming back, you've missed out. You never recover that. And I worry about missing whenever that day is going to be, whether it's this year or next year or 5 years from now. And so I don't, my opinion is that given our restrictions with our process, that we need to keep the funds in equity, even though I don't know that's a winning strategy for this year. I don't know that there's a solution of where the winning strategy is. I don't think the way things are now, I think everybody's going to be taking a hit. So how do we optimize that? I think we stick with something similar to what we've been following and the recommended allocation. That's a summary of my thoughts for whatever.
Let me ask you a question. Within the
Yeah.
allocation we have, and this is
Yeah.
what I'm trying to understand the process. Within the allocation we have, not even changing it, we had a range of 65 to 50 on equities.
Mhm,
In January, we were pushing 67, 68.
mhm.
Okay. Why could we not have within a meeting drop to 50 within our range? Within our range, we're not talking about changing allocation, we're not talking about changing percentages. Why did it take us 3+ meetings not to be able to, within that range, work within a meeting? Can you help me understand that?
I'm not sure I'm following.
Okay.
We're talking, because
We have
we got-
ranges in our
We
allocation.
have the targets and then we have the actuals. And the actuals, no matter how we change the targets, the actuals can't shift with changes in target quickly. It's a big ship that can't turn around immediately. We basically manage it through where we're taking funds out versus where we're putting funds in. Is that, am I wrong in that?
No, I'm not understanding.
Okay.
Have we?
No, just so what you were talking about, so we have targets and then ranges around it. And so I think in our IPS, it's we have to have at least 50% in equities and no more than it's 70 or 75, I'll have to check.
Right.
And so Jody, what you're talking about is, for the most part, you're right. We pull out about $2-3 million a month from the portfolio to pay benefits. So a lot of times on purpose, that's how we rebalance the portfolio because it's more gradual and we do it that way.
Mhm.
Specifically what Sharik is talking about is if in January this year, if we're at 66 in equities, we're allowed to go down to 50. Why didn't we decide, or why don't we decide, could we decide to go down to 50? And that is something that we, you have to decide where to put the money. I assume in
Yeah.
fixed income, we're holding cash.
Yeah,
That's another part of the decision. And that's something that we have in place with existing managers. It wouldn't be like maybe the next day, but it could be
Right.
relatively quick.
So, just to
Yeah.
clarify,
okay, yeah,
it could have been done.
yeah,
We weren't able to make a decision.
right.
We would have been not violating
No,
any,
I think that's misstated. It's not that we weren't able to make a decision. You nor I put that on the table as a specific
I
decision
didn't.
to be made. No. You didn't make you talked about it in broad terms.
I'm
But there was never-
not critiquing, I'm trying to understand.
We never specifically talked about, should we move money or had a motion, for example, should we take 10% out of equities and put it in fixed income?
I did, if you go to the January meeting, I did, and we said we would make this formal motion in February, let's delay it till then. Okay, I don't know why, I could have made the motion at that time, but said make the motion. We were not ready to make that decision at that time. It's not a critique, I'm trying to understand moving forward. It's more of an understanding of what we want to do, what we don't want to do, so we don't have this discussion every time. That we don't even have this discussion next time, that, hey, this is something we are not gonna do, don't even bring it up. I'm okay with that, I just need to know.
Okay, could I, other members of the board like to add to the conversation? Pepe? You have any thoughts?
I just want to be sure I understand correctly if what you're talking about, Troy, is, okay, we did that now and we reduced it and had whatever percentage in short-term treasuries. Are we then making the decision at what point to get out of treasuries and back into the equity market? Because I mean, I gotta tell you, I don't personally feel qualified and have the knowledge base and the information to be able to say, okay, now let's move to something else. My understanding was that's what we relied on ACG to do, but maybe I
They're not
don't
doing it.
understand correctly.
That's what I wanted to bring up, that they are not doing this. They are leaving the decision to us. They are not gonna do that. They've said that clearly, they're not gonna make allocation decisions. To answer your question, which is a good question,
What they've said, they're not, they don't have the authority to make a decision, but they don't recommend tactical asset allocation. It's more specifically,
so,
right?
so to answer,
Isn't that correct? Penny?
Correct. So yeah, we don't have the legal authority to actually make moves ourselves. The board has to approve those moves. And then our personal opinion is yes, tactical moves like that, we would not recommend.
Just want to make certain everybody understand what your role actually is. Go ahead, please. Go ahead.
That's the, I mean, for me, that's the answer in terms of I'm not qualified to make tactical decisions about we should get out of stocks now into treasuries, and then when do we move back? When do we buy gold or real estate or whatever it is? And so then if that's
and
the way we want to administer the plan, sorry, Finney, to say this, but then if that's the way we want to operate, I'm more comfortable than finding a consultant that wants to operate that way than relying on me as a layperson to to be able to make.
No, I think that's a great comment.
I concur.
Yeah, so I think that's a great comment. That's why I say we have to find a solution. And also to clarify, we are not talking about tactical decisions all the time, but we are talking about when valuations are way out of line. I mean, this is not something that happens every year. Okay, this has been happening last couple of years, mainly in the last year, where things have been way out of line. And then if we are not able to make some basic decisions on that basis, we are not doing an asset allocation job that somebody on these three layers need to be doing. And we went through the three layers. Managers are not going to do it. They are not going to do it. We are not going to do it. Nobody's doing it. That's my only concern. We have to address that. If this is true, okay, let's say it's not, but let's say this is true. How are we going to address it? Are we doing anything? Are we prepared to do anything to say that is there a solve? And we're not going to come up with the truth, but but we have to be able to. That's all I'm saying.
Just so the board understands, there are other investment consultants who actually take control, you delegate the authority for them to make the asset allocation decisions, both strategic as well as tactical. And then they do all that. And they simply report to the board as to what they've done and justify what they've done and talk to us about what they think they may want to do in the near future or the intermediate term. That can be done. Mercer operates that way. Who else?
Well, everyone does
Right,
that,
so-
I mean,
Does
so ACG
ACG
does that, but I
well,
think,
But
again,
what you typically come up with is still a long-term asset allocation with occasional tactical tweaks.
But it sounds like that's what Sharik is talking about.
I'm not talking about, to clarify, I'm not talking about continuous tactical allocation change.
Right.
What I'm talking about is when major forces are at play.
To what Milt said, to have occasional tactical tweaks when the situation calls for it. As
mean,
I
at least-
understand what you're saying.
Yeah, I mean, at least on an annual basis or whatever, 10% or whatever, we take it out, we see some opportunity exists that we put it in, yes, or let somebody else do it, I'm fine with that. Like you said, if people are uncomfortable, let somebody else do it. But are we doing a disservice by nobody doing it in this whole chain going up and down? Are we doing a disservice? I think we have to talk about that.
So I think we have totally two different conversations happening right now. I think there's a one conversation, which is we need an approval today just to say, what are the target allocations over a 10-year period? Within that, we have the option, if somebody wants to make a vote, to say, I know that that's the long-term targets, but today I want to be different than the long-term targets.
Right.
I think that's a separate conversation. I think today we need to focus on what is that portfolio structure that we think is going to yield 7.25% over the long term.
Mhm.
We need to have that conversation, and then we can talk about what do we want to do when we believe that there are reasons to be different than that target allocation. And I think we should defer
But the
that
environment is
conversation.
so challenging and severe.
Right.
That we need to do something today and then move back to that long-term
Right.
channel.
So I would encourage us just to focus on what
And Tony, I'm fine with that. That's why I said that at some point we need to
Yeah.
have this discussion.
totally fine with that. So I just think if we try to have that conversation, we're never going to be able
No,
to.
I said that I have a lot to say and I won't say it. I just want to say, bring it up and we say that how are we going to approach it later? Or are we going to approach it?
And if we are just focused on what is that long-term target allocation that could get us 7.25%, I do have a few comments on the
Please.
illustration, which is big. I really appreciate the work here. I do. It's great. I know we've been at this a long time. Just a couple of questions and observations. One question is, should we be thinking about an inflation target within this? So in other words, those capital market assumptions, does ACG also have an inflation target? And would that be an important data point for us to think about, because now we're thinking about real returns. And I don't know that I don't even know how to think about that, honestly. So that's an open-ended question of help me, get my head around them. Because, and the reason it occurs to me is we look about past returns, basically inflation's been virtually zero over a 10-year period. Well, that's not going to be the case over the next year period. So equity returns that were double digits over the last 10 years, that was all real return. If we have lower returns and higher inflation, our real returns are going to be much, much lower. And how should we think about that? So it's just an open-ended question. Hold on, I'll ask all my questions and then you can just take them in one. The other, your capital market assumptions don't have specific return targets for international small cap, but yet we have a target allocation to small cap. So I don't know how to think about that. But I also think the fact that you have higher return targets for developed international versus US, I think we should be more attentive to that. And the fact that we're still overweight US relative to non-US. I know Milt has talked about this a lot. I don't know that the overweight to US is supported using the capital market assumptions. So I would like us to maybe just talk about that a little bit more as well. So inflation target for international small cap and maybe a little bit more balance between US and non-US given ACG's capital market assumptions.
Sure. So start off with inflation. So inflation is an input into our capital market assumptions. We get this directly from the 10-year TIPS break even. So what the market is implying at the beginning of year, what inflation will be. Like anything else, we don't say we have a crystal ball it's going to be, but this is what the market's telling us inflation would be the next 10 years.
So it is incorporated as you create your.
As I create, yeah. So into the inputs that create our asset class capital market assumptions. So these are the assumptions that we are showing are nominal returns. So the inflation is part of that. The big reason why that's important for us, this 7.25% that we're trying to hit is a nominal return. Our liabilities that our actuary use, they grow in nominal terms. They have assumptions for inflation, and inflation kind of ultimately plays out what it's going to be.
Yeah.
But what we're trying to match is this 7.25%. That's nominally, that's inclusive of inflation. And so having a specific real return, honestly, that's a little bit, we think apples to oranges versus what we're shooting for.
Okay.
The international small cap. So we do have an international small cap specific assumption. It's on page, that's kind of highlighted on page 9, what our target is. I think, Tony, the page you're looking at, and that's my error there. I probably didn't include that on this page to kind of show actually what they are. In previous versions, I had kind of an appendix with all the underlying ones.
You said page 9, but it's.
Yes.
This document?
What?
Yeah, I'm sorry, maybe I misunderstood you. You said the international small cap assumption is on page.
No, I'm sorry. The assumption is not on page 9. It's broken out on page 9, the specific target, and that does correlate to a specific assumption. I did not include that on page 7. Apologize. There was a separate version the previous time. But anyway, if your question is, Tony, are we incorporating a specific international small cap assumption? Yes, we are. I just don't have it off the top of my head what that actual number is. And then your comment on US international. So I guess just to be clear, we are favoring well, I guess here's the question. What we are favoring is owning less international than the universe is available. And so specifically to Sharik's, I think his point, what we are thinking about here is, really the high valuation, the expensive area is the US large cap side. We're not seeing those same numbers necessarily on the small cap side. So if you look at, so again, page 8, the global opportunity set is 2/3 US. And then this bottom graph, it's predominantly large cap. It's 75%. Right. So in other words, you put that together, what this is saying is 50%, 75% of 66 would be US large cap in your equity exposure. Right. And our recommendation on page 9, the 60/40, our exposure to large cap is like 38% of the broad universe. So that's how we're showing it. I guess the best way to say it, Tony, is you're right. Capital market assumptions would say we'd actually have a higher than 50% international than we would in US. But I guess the reason we're not is because the market cap of the world is so heavily skewed 2/3 to 1.
I understand.
And so we would be, and that would, in our view, would be taking a very significant bet, tilt, whatever we want to call, relative to kind of what the opportunity set is.
Yeah.
And so maybe no other way to say it, I agree, ACG agrees a lot in kind of theory, what Sharik is saying, that large cap is overweight or overvalued, US is overvalued. And again, this is why it's 38% of our equity allocation, not 50 like Acme would say. The question becomes, how low do you drop that? And the reality is we can't call that, right? If you look at where the market is after this tariff pull down, it's the same level it was back in June of last year, right? The same price level. So if we would have had the same conversation and we should get out at that point, well, then it rallied a tremendous amount to start the year and it fell back down. You got to make those calls, when to get in, when to get out, both correct. And we don't think we do, and it's not just a comment on us, we don't think anybody has that ability to exactly do that.
I think I sent you and Jason an email. Have you calculated what the PE ratios for US equities are, or at least the S&P 500, on a equal weighted basis rather than a market cap basis?
No. So it's certainly lower on an equal weighted basis, obviously. I don't have it in here, so I don't know what, we had shared that at some point, yeah.
It's okay.
Well, I guess just at a very big picture, the 60/40 allocation that you're showing here does get us to the return objective. I just wonder if we just tweak that a little bit, could we also get to that return objective and also have lower volatility? And here's the thinking behind that. Firstly, if we preserve that 25.75, if I could round that to 26 just to make it easy, to US, we're basically putting a quarter of a portfolio in something that we don't think is going to hit our return target at 6.8, using your capital market assumptions on page 6. We also, I would argue that the international developed and the US small cap has very, very similar returns, just using your capital market assumptions, but small caps are going to be way more risky. So would it benefit us to have a lower allocation to both US and US large and US small in favor of developed international, just using your capital market assumptions?
So say again, Tony, switching that allocation from,
If we showed a little, if we did an illustration with a little bit lower allocation to US, both US large and small.
so like the third, no, page 9 ballpark.
You say 55,
Yeah, so
55,
50-50.
45 or 50-50? What are we?
Well, let's just, I mean, I think 50/50 could actually work, but I realize that
It
that
has
might,
worked, it has worked in the past. Matter of fact, when I was with Mercy.
Yeah.
For years, I recommended 50/50.
Yeah.
And was very successful.
Yep.
Until 2008 and everything began to crash.
And so,
But go, no, I interrupted you. Finish your point.
oh, yeah, and I haven't penciled out the exact allocations, but just tightening up, there's a 10% differential between US and non-US large. I just don't, that just seems very large to me in light of your capital market assumptions. So 25, I'm just looking at the US large cap line at 25.75 and the developed line of 14%. We're saying we're going to put 10% more in a asset class that has a lower return target and higher valuations right now. And I just, does that really make sense? And should we have a lower number for the US and higher number for the non-US?
so this is the debate we can talk about. The reason for this recommendation, again, is
I get it,
A,
relative to equity, I get it.
the
I
global
totally-
economy, but also, again, you have US, well, as we've broken out on here, you have large cap and small. You have basically developed, large cap, small cap, and EM.
Right.
So you have to, there's
Yeah.
basically 3 mouths to feed
Totally get it.
in our portfolio on the international side. And so listen to,
Well, I guess ultimately what I would say is I would be very comfortable with a higher allocation to developed international markets in favor of all the other categories, specifically the US, large and small.
and again, we give recommendations, you guys make the decisions.
Yeah.
The one thing, your comment, Tony, on, in itself, US large cap's not going to get 7.25. What I want to be cognizant of there, again, why we have it, if you flip back to page 6, again, these capital market assumptions on an annual basis can change quite a bit. So just in particular, looking at 2022, again, this is before the Fed raised rates. Things were certainly high valuations there. And so, our expectation at the time was for, what is that, 5% US large cap going forward? Of course, if we were to make a specific change just based on that box, you're missing, 23, you're missing 24, where the market was up over 25% per year. And so ultimately, and again, this is the thing you guys have to keep in mind. We don't include on here because it's not as relevant, but so yes, relative to ACWI, this is kind of what the Global Opportunity says it is. Also relative to other public pension plans, I'd say in general are more overweight to US than ACWI is. And we've kind of shown that before, and it shows up in kind of the ranks why we have tripped over the last several years. And so, we have constituents, we have, retirees who are looking at this and wanting the plan to succeed. And so going down to 50-50 is, well, it's a big change for what the actual current market is telling us.
Yeah, and I'm not even saying it's the right answer. I'm just kind of thinking about a portfolio that aligns prudently with your capital market. That's all. And there are equity categories on here that don't achieve based on your 10-year returns. You're saying on page 6, certain of these categories are not going to give us the 7.25% return. We look at, we've got healthy allocations to those.
Yeah.
And don't have healthy allocations to those categories that will achieve the 7.25%. That's all I'm saying.
And again, I'll take fault for this, but part of it because.
So therefore, what would you recommend specifically?
Well, I don't know exact percentages, but something I would say the right recommendation would be something closer to like a 22.
55, 45?
Well, like US, let me
Let's
just,
talk about domestic and international, and then we can talk about what goes into the domestic.
well,
Or alternative, we can leave it at 60-40 and just move the domestic allocations around. But I thought you had something more
I can,
of international allocation.
I can't think that fast, but I can try. But I mean, right now, the US allocation is 34% and the non-US is 27%.
Right now, in theory, it's 60-40.
Right. And I would just say something that's a little bit more balanced there would make a lot of sense. I would say let's just say we take US from 34 to 30. I'm just making that up, and take that other 4% from 27% non-US to 31%. I would be comfortable with that.
Okay, what does that work out to? Could you repeat what you just said? I don't have my calculator handy. So Phineas must have something we can use.
Well, I'm sorry, I'm doing this on the fly too, Mill.
That's
I didn't know
all right.
you were going to ask me this question. I was just talking conceptually.
We are making this question.
Yeah.
It's nothing more important.
So let me just look at this real quick. I mean,
And I'm the person who was arguing in favor of more of a 65-35, and what happened was this tariff situation.
Yeah.
Because now I have no idea where the opportunities will really reside. Is it going to be domestic or international? Because we don't now know what the E is going to be.
Right.
We may not have a better idea of what the E will be in 3 or 4 months, but we don't know right today. The E meaning the E of the PE.
45.
So you suggested decreasing large cap or domestic equities 4 percentage points.
Yeah, basically from
And adding
34 to
4 percentage
40%.
points onto the international.
Yep, that's
Is that correct?
yeah, that's basically it.
So
Yeah.
basically that's 56-44.
Yeah.
So we can just round it off at 55-45. Is it? Would that be comfortable?
Yep.
So that's something I have here as one of the alternatives.
I would do
So
that.
55-45, and I think in one, to somewhat, I guess, answer Tony's question, and again, I'll unfold for this because we've had a lot of versions. I've tried to slim them as we
Yeah, I
keep
know.
coming back. But the other aspect that the legs that aren't factored in here are the standard deviation of volatility.
Yeah.
It's not just the returns that are shown.
Yeah.
And so ultimately, you can kind of see that basically, while we're higher expected returns on the international side from our model, there is higher volatility associated with that. So as you can kind of see the 50-50, the 55-45 relative, this is all very, very close. But
It's essentially the same.
it's essentially the same, but it just, it does,
No,
there's a
you-
little bit of
you-
trade-off.
You can measure, but
in
there's no
return.
difference between 12.65 and 12.76.
Yep.
There is no difference. I mean, arithmetically, there's a difference, but fundamentally, there is no difference between the two in terms of standard deviation.
Mhm.
Agreed. I think all of these, again, we know it's not going to play out exactly like this, no matter what we say.
Yeah.
That's the one for sure. All are very close.
But
If you're gonna,
thematically, Tony is advocating a higher allocation international equities. And it's hard, at this point, given the tariff situation, it's hard to argue against that.
Yeah.
Because it's hard to argue for anything at this particular point.
Yeah.
But it's certainly hard to argue against that. Now, over the last 10 years, it would not have worked. It would not have been as successful as domestically centered allocation. But 55-45 is as reasonable as anything at this point.
I actually kind of concur. I'm not opposed to a 60-40, but a 55-45 seems very reasonable to me, given the tariff situation. And the fact that we can tweak this as we go.
Right.
And also, as I've already said, these are targets versus actual anyway.
That's right.
Yeah, so I would probably lean towards 55-45, but I'm okay with the 60-40. If we put it to a vote, I'm not opposed to either of those.
It's part of what factors into this conversation, then where the 5% we're taking out of real estate goes.
Mhm.
yeah. So,
And then- wait, I'm gonna throw a fly in the ointment. To Sharik's point, does it make sense to think about in the current environment? Since we don't, 60-40, 55, we don't know, to take that 5% and put it in short-term treasuries?
Pepe, may I?
Absolutely.
I think that's a separate question. I think all we're trying to say is, what is the long-term target that we should be comfortable with? Once we set that, then we can say, relative to that target, we can make some adjustments. And today, we think it's one of those decisions. So
Yes.
I think if we say we want short-term treasuries, ACG is going to hear that as your over the next 10 years, you're going to have an allocation target to short-term treasuries. And I don't think we're
gonna.
right. So I would say, I would love the conversation. It's just, we should have it after we set the
Yes.
long-term target.
Yeah, I'd like to get some closure on this and move forward with that other conversation.
Here,
Okay.
And that's
Are there-
another question.
you may. Would you might like to make a motion?
You're asking me to do math again, I think, Mel, and I'm,
Not really. It's already spelled out. Unless you want to be 56-44, which is.
I think when
Sitting
I get the 55-45, I'm still not exactly sure. There's 5 subcategories, and I don't know what our specific target is to those 5 subcategories.
Well, let's talk about 55-45.
Yeah, I like that.
And then we can talk about the allocations to the individual asset classes within the 55 and within the 45.
I love it. Yeah.
Okay.
Yep.
Do you want to make a motion on the 55-45?
Is it okay to do that, or do we really need to have the targets to all 5 subcategories first?
I just want to
Okay.
have
I
one thing.
make a motion that within the equity allocation, that we have a target allocation to 55% US and 45% non-US.
I second the motion. Discussion? Question?
and just for clarification, that includes private equity as part of US.
Correct.
Yep.
Private equity is equity. It just
Yep.
happens to be private as opposed to public.
Mhm. Although this doesn't show it changing across the line.
No, so we've kept private equity static.
Yeah.
That's kind of a target.
But I think they're saying, but the way that we're building private equity, it's really US exposure, so it's gonna eat up 6% of that 55%.
Paul, you have any other questions?
I don't hear any expert at this table having severe, major concerns about either one, so I'm inclined to support.
I've already argued that international valuations are better for the last many months, so I have no problem with that. in terms of the goal.
Yeah, what is the word for it? The kicker is that international valuations have been better for the last 10 years. They just haven't worked. But
Yeah.
nevertheless, we have a motion.
There's the reason it hasn't worked, and we need to be aware of why it hasn't worked when we make that comment.
All right, we have a motion, it's been seconded. All those in favor of moving from 60-40 currently to a target of 55-45.
Aye.
Aye.
Okay, we have, Sharik, are you abstaining?
I'm fine with it.
You're fine, you vote in favor in that case, right?
Of more international, yes,
Okay,
within
fine.
that, yes.
Okay, that motion's carried.
Is it 7?
All seven.
All seven
Okay.
have voted
Okay.
aye.
Unanimous.
All right.
All right, now the second thing you posed is, well, where does that, where do you, individual asset class wise, where does the 5% to international go?
Yep.
And it may be pro rata, or we may say we want it to go to emerging markets,
Yep.
just as two extremes.
Yep.
What is your thinking there?
Well, again, I have to do the math, but I would say just generally, I would, on the non-US side, I would have a higher allocation to developed than small cap and than what's being reflected in the international small cap and EM. And the reason is because again, I'm just reacting to the capital market assumptions on page 6, but a 7.4% return for international developed is pretty appealing. And the fact that that's higher than EM equity, and EM equity has higher volatility, I would be inclined to have a higher allocation to the developed side than the EM side.
Unfortunately,
And I
when
don't
we
know-
talk about EM, we are implicitly including China, and China is the wild card.
Yeah.
We really don't know. Because China is, well, all the emerging market countries that feed the United States with
Yep.
exports are going to be affected somehow. But I understand the difficulty.
Yeah.
Yeah. So, what is your suggestion?
Well, again, I have to do math on the fly, but I would just say,
Want to just add,
so
3
what-
points to large cap?
yeah, yep, that's as a starting point. I think that's great.
Can I
And
just,
and the other 2 points, what would you suggest?
And I would just put it in large also.
All 5 points are large.
Developed is the way it's listed here. But I know what Finney's thinking, like, look, these are just projections. We don't know if these projections are gonna be right, but these capital market assumptions are the basis of which we're trying to set long-term targets. I know they're gonna change annually. We can have that conversation, but just today, the environment that we're in, looking at just returns only, and I realize the volatility numbers are not represented here, but international developed, I would say that's a much more appealing category for a pension plan right now than emerging markets. It has a higher expected return. I don't know the volatility numbers, but I'm assuming that you're going to show lower volatility for international developed than EM.
Certainly.
yeah, no, there is more volatility. Yes.
Right. So it's hard not to want to bias the portfolio to a higher allocation. And, if you just think about developed and EM, just those two alone, we have a 33% weighting. And that just seems like a way too high allocation to emerging markets, given the capital market assumptions.
All right. We'll make that motion.
One,
Motion to move.
Before the motion, I'm
Discussion,
confused.
please.
I'm confused. We said we're gonna separate out the 2 decisions. We're gonna make a 10-year asset allocation. That doesn't mean immediate allocation to that category right now. So I would say while I agree with the 5% more internationally, I do not agree with that being done immediately. I would like that money to be parked in short-term treasuries earning 4%, because the correlation on the way down is 1. And while we're talking about projections, Jeremy Grantham, GMO Capital, I don't know if most people know about it, but that's like the number one projection house, so-called, or the most prestigious, one of the most prestigious. And Jeremy Grantham, by the way, also predicted the 2000 as well, the financial crisis of 08. He was right on both.
Mhm.
And what he's made a comment recently, we are not aware of, is that we are in a Japan-like bubble and a lost decade, but is where we are right now. Whether he's right or wrong, I'm not commenting on that.
Is he?
I'm talking about,
In that statement, was he talking about domestic equities or international equities broadly?
again, on the way down, the correlation is
His specific, oh, you're talking about
correct.
all
On
equities.
the way down, the
World
correlation
equities.
is one. Yes.
Okay, okay.
So it doesn't matter. So here's what I'm saying. So when we talk about projections, we can look at the most prestigious place and say, what are they? They could be wrong, but we could look at that. But also, just a comment that while we're voting on this, I would not, while the 10-year projection more international, I have no problem. I don't think the immediate allocation to it is a correct decision. I could be wrong, but that's my comment.
So you would want to park that 5 percentage points. Well, actually, you don't have a 55-45 allocation, but you would want to park that 5 percentage points short term.
It could be in one of the bond fund.
But I still, can I just ask, 'cause I think we should just focus on what we want the targets to be and then have the second
But
conversation.
we
around
did, we
what it is.
moved on from there for immediate allocation of that money, and that's where I'm having a problem.
I'm not saying that. I'm not saying that at all. I'm saying we need to have an investment policy that has targets in it.
Okay, but we started talking about the money manager, where that money would be parked immediately.
Well, I think we have to have that conversation separately. That's an implementation decision.
So I thought you were talking about implementation, when we said we're
No,
gonna.
I think we're still trying to set policy targets.
I understood us to still be talking about the target.
Right.
Just
We're not-
the allocation within equity of
So
the
how are we gonna do that,
55,
Tony? We're
45.
gonna say it goes to that manager, but doesn't go to the manager yet?
I think, can we have that conversation after we set the
Okay.
policy
All right.
targets? That's all I would say. Is I think
Just
we
to be
need-
clear, okay.
Yeah, no, I think it's a good question. It's just,
No,
I
that's
think
fine,
it's-
if that's the
it's a-
case, and then.
yeah, I think it's not one question. Is correct. Yeah, that's exactly right. Or what's actually this column we're working off of.
So,
Mhm.
one comment, it's kind of not related, but it's definitely related, I guess, before you make target bet. So our international targets as of now, if you all remember, we used to have 2 international small cap managers. We rolled that into Silchester, but what I'm saying, Milt, is at the time, the board declined to reduce our international small cap target in our IPS, even though we reduced our international small cap manager. So in reality, we have one international small cap manager, William Blair, that is about 3% of the portfolio. And Silchester, because they're all cap, the board decided at the time that they were very fine just leaving the small cap target as it is.
What does it have to do with the decision?
Well, it's just as Tony's talking about, in particular, what our weight is, international small cap.
Because
It's-
that's their.
Again,
I have one more question. So,
Since we're
Where-
going
just
to a 55, we're adding
Oh.
5%, putting them in here somewhere.
Okay,
Does that make
so
sense?
one more question, Tony, and the rest is that for this international allocation, can we consider a passive strategy for this allocation versus choosing between the 2 managers we have? That would be my recommendation.
well, that's a different decision. We certainly.
Whenever we address that,
But that's a different.
yeah, so we'll have to
decision.
change that when we come back later. So if we decide that.
All right, but I think Tony's motion, which is still on the table, is that we take that 5 percentage points and we put it for international large cap, which is titled International Developed Equity here. That's where it would go. Do I understand correctly, Tony?
Yes, that's right.
I'm clear about where
This could be an option.
those 5
Yes,
are coming from.
Yeah.
It's coming from large cap US.
well, since we
Correct.
voted on.
Versus
Cap,
the-
we're
Can't
small
change
cap.
these.
Okay,
We're
but it's
moving
coming from
these
US
as
equity versus
were.
the other 5%.
We're moving
We're talking
from
about
the two
taking out of
things.
the state.
We're bringing 5% in.
Yep.
And we're changing how much.
Okay.
Is that right?
Usually tied- it's some-
It's all coming out of your large caps.
Yeah,
Well,
so that's why.
Happy's right, but also we have to account for the 5% reduction in private, or.
Come back to that as a separate.
From this, which is this, over to here. So we just put 5% down here.
So Paul, another way to say, it, right now, our target to equities is 63%. It does go up to 68%. So,
And there is a recommended
Right.
or suggested, I should say, distribution there.
Right.
But you would prefer that the whole 5%. Well, actually, between the target of 23.5 plus 7.75, which is 31. That is essentially the same under the 55-45, so we can call that a wash. Pepe. So
Okay,
basically, it's going into, as you see there, 15.75, 6.75, and 8.
Mhm.
Is that correct?
So yeah, the recommendation on the right is 55-45 is basically there's 5% movement to equity. It's basically 25 basis points is going to US large cap and the other 4.75 is going to international. We can adjust that as you see fit. I think Tony's doing some calculations now.
I'm trying.
And just for what it's worth on the on this 55-45, so that EM at 8%, that's about 25% of the international. So that's just a number to keep in mind if you're looking to base.
Say that
something
again.
on. The 8% to EM,
Yeah,
it's like 25, it's approximately 25%. I think it's like 25 point something percent of the international breakdown.
okay.
We tried to kind of round to whole numbers.
Oh, you were right here. Yeah, so Finney's working off of that column. Yeah. Okay.
What is it under the target allocation? Since I don't have my calculator here, I thought I brought it, but I didn't. Emerging markets as a percentage
Of
of
international?
international allocation. Under the target, the current target. Are we actually increasing the relative weight of emerging markets in the international allocation, or are we keeping it the same? That's
I think it's
an
all
arithmetic
prorated.
question. That's not a philosophical question.
So the target is 26%, and that's about, and let me see. I think it's the exact same on what we have listed under 55-45. It's 26%. Double check
That 8 percentage points represents 26% of the international.
Of the
allocation. Is
international,
that correct?
I
yes.
think that's. Yeah, I think,
That isn't consistent with what you would like, you suggested we do, I think.
yeah, I think that's too high. And I think it may, just a simple math would be if international developed, looking at that 55-45 column went from 15.75 to 20 and the international small cap and EM were 5% each, I think that would be a more prudent allocation.
Could you repeat that, please?
Yeah, so I'm just looking at that 55-45 column, the non-US piece. Right now, the allocations are international developed at 15.75. I would say, I'm just gonna use round numbers, take that to 20%, and international small cap and EM are 6.7 and 8% respectively. I think we could make those 5%.
So it'd be 30%.
Yeah, it's, and I think technically we need to get
30,
higher
30
than
and
that.
30,
right?
okay, 30.
19.5,
Yeah.
to get to 30.5.
30, yep, yep.
Okay.
Aaron's better at math than I am, so he's got it all figured out over there.
Are you leaving?
No, restroom.
Okay, fine, very good.
Yeah.
All right,
And if
Just-
we,
because you also have a private equity in here, so that boosts the the domestic allocation.
Right, yeah.
So on public equities, in the US, it would be 30%, approximately 31%. International would be 30%.
correct.
But the private equity pushes that domestic up to 36%.
Yeah, right. And that's what we need 37, 31 to be this 55-45. Yeah.
So Tony, if you just maybe want to read down the equity column, whatever thing.
Yeah, I think, I'm not using the decimals here, but I think we're gonna be something like, well, I did tinker with it. So on the US side, I think something like,
Can you read off each category one by one?
Yeah.
And see what you're trying to do there.
So that's what
yeah, that's exactly what I'm,
Just read it slowly so we can all write it down
okay,
and then try to follow you.
all right. Well, if we had US large at 24%, small cap at 7%, and private equity at 6%.
1 second, US large at 24, and what's the range? Are we defining ranges or we're not?
Right now, that's what
Okay, US large and then what?
Small cap, US small cap 7, and then private equity 6.
So 36,
So that's 37%.
37, excuse me.
Which
Yeah.
is 55% of 68%. And on the non-US side, we have to get to
That's
31%
55 because you're going 55
of 68.
45.
Yeah,
So
right.
that
50
defines the US there.
Correct, yeah.
Okay.
So that's 55% of 68%, which is the
Okay.
target allocation.
Okay,
And then I cheated off of Aaron's paper and I got international developed as 21%. And then international small cap would be 5%.
sorry, international developer was what?
21.
Mhm.
And then the other two categories, international small cap and EM, both at 5%, which is 31%. And that's 45% of 68%.
International small and the other international is what? Developed, you said? 5%?
Correct. Yep.
International small is 5, emerging markets is 5, is what Tony said.
So 31 and 37.
Right.
So 31 and 37, so if you divide 37 by 68,
That should be 55%.
54.4.
I did round. So. Yep.
What are the numbers?
20, 24, 7, and 6. Up on that, so there's
Oh.
US, and then 21, 5, and 5.
Gotcha.
It's because we're dealing with decimals here.
Yeah,
So they're not even numbers.
Formal on this?
I would be prepared to make a recommendation on that. I know we don't have the complete illustrations, but just using the capital market assumptions on page 6 and knowing the general volatility of those asset classes, I would be comfortable with that.
Are we opposed to reducing US large anymore? I mean, if that's a consensus decision, it is the decision. I'm just
Yeah.
asking.
Well,
I would be.
I think it's a
would
good
like-
question, because one of the things that's happening as we do this is we are increasing our equity allocation because we're reducing real estate. So that's embedded in all of these actions. is
Why do we
we're-
have to do that? Why can't we just put it into bonds for the time being?
That's-
That was my
well,
question.
Again, if it's the
How
time
said
being,
that?
well, again, it's two different questions.
No, I
which
get
is,
that.
We could say, over the long term, we think equities, 10 years, over the long term, we think equities are going to do better than real estate. If we don't believe that, then we shouldn't increase from 63 to 68% equities. We should take our fixed income from 11 to 16%. But, or just leave real estate at that 15% target. So I think that's what's,
I think, and again, just so I'm clear and I understand, what these numbers represent are a long-term,
policy.
10-year
Yep,
policy.
correct.
However, when we make the tactical decision to take the 5% from real estate,
We could say just put it in
We
treasuries or
can
core
say,
bonds right now,
put
or even
that-
money market. Yeah.
right, to do something else other than add to
Yep.
these equity positions. That's all I want to be clear about.
But doing this is
It's in the-
taking it 5% and adding it to the equity, right?
Just by policy. We could say,
But we could always, gotcha.
yeah, but we say that's the long term. ACG help us keep us on track for long term, but right this second, we don't want to be at target, and here's why.
Are we mixing mid and small in the 7%? Or is it specific because you said small? So is it specifically small and we have no mid cap allocation?
That's correct, and again.
Actually, our implementation is mid cap.
So mid is included in the 7%.
Yes. By implementation with managers, which we can change. Managers, obviously.
I would actually say that we give a couple more percentages and put it into small because it includes, it's a SMID allocation, it's not a small cap allocation.
You're talking about the international now, or?
No, US from 24, we go 21 and 10 Smith because it's not small cap. With small cap, I would agree 7%, but since it's Smith, then I would say make it 10.
Yeah,
And
we
with
have-
a large cap.
One of our managers already is a Smith manager.
No, that's what I'm saying. So that's in the 7%.
Yeah.
So then go to 10 on small, mid, and reduce the large to 21.
Happy with that.
I'm not against that at all. The only thing I would say, we do need to be cognizant that private equity is made up of mostly small and micro companies, even though they're private, but that gives us the exposure
But we
there.
still need a Smith.
Yeah, totally. I'm not against it at all, just saying.
You got that?
So 21 and 10.
And 6, for private.
Do you have a headache yet, Finney?
No, I mean, this is your guys' portfolio. We're here to give recommendations. I mean, I do have some thoughts on this that if you want to hear them, but again, this is your decision. And so really just thoughts overall on this is, so of our overall portfolio, it's 30% US large cap. And really what we're comparing ourselves to is 50% US large cap. So that's a big delta. It'll be a big difference relative to what peers do. That's, again, don't know what's that.
Phineas, we don't care.
I know, but I'm just making,
No, I want you to understand, we don't care. You made that point. We don't care.
uh,
We want to do what we think is right. And maybe a lot of those other guys will come around to our own thinking. But when I was with Mercer, reason our clients were in the top tier of their universe, it's because we did what we thought was right rather than what was consistent with everybody else. We don't care.
I want to make the point, and I have, and that's great. What I would say, so directionally, I know it's 25 basis points, but just lowering private equity, we're typically not a fan of where we are. And then the other part of EM now at about 15% of international. I think frankly, we would, from a diversification return standpoint, we would like to see that a little bit higher, but that's all the main comments.
So Penny, are all three of our large cap managers, the two active and the one passive?
One pass, yes.
Correct? Are they all truly in that 25% all large cap, or is there a slight mid exposure there?
The two, Jennison not as much. Aristotle probably does cheat a little bit into mid cap, but not significantly.
Rumline is the center. That's close. And that's against the Russell 1000. So it is large and
But that was my point. So if that's the case, and if they're being categorized in our large, then it's not truly when we allocate 25 is or 24, sorry, it's not truly large cap. So if Penny is concerned that we have a big delta, we can leave it large cap because we're getting mid exposure from our managers.
from Rumline.
From one,
Correct. And
I do
Rumline
not,
is the
I
one
do
that's
not
been
recall
performing.
offhand how much of the Rumline allocation by definition is mid-cap. I do not recall that, but you would know.
Rumline is in the
It's
S&P
Russell
500,
So it's replicating S&P 500.
so it doesn't have any.
S&P 500s.
Russell
So we're
1000.
okay.
Rumline's.
No, Rumline is S&P 500, so it has no
S&P
mid
500.
cap. In our small cap portfolio, one of our managers is really, granted is small and micro, doesn't have much, really any mid cap. Ernest does have mid cap. So that's one of our small mid managers.
Okay, it is large. Totally large. I was thinking it was the Russell 1000.
Since Drumline is also a little bit, I said S&P
Yeah, well,
500, I take
It's-
us back because it's not true large cap.
Yeah.
If you want to go back to 24, sorry, and 7, I'm okay with that because it's not a true large cap exposure.
So you're okay going back to 24 and 7.
Because it's not a true large cap exposure.
Understood.
It is not correct. And I'm okay with Drumline having it, so I do not have it.
Okay, so we're back at Tony's motion. I would second that.
Okay, just to understand the motion, I'd like to summarize that we're looking at US 24, 7, and 6 to get to their 37.
Yep.
And 21, 5, and 5 for the international.
Right.
Okay.
Tony made the recommendation.
Motion.
Motion,
Oh, yeah,
sorry.
second.
All seconded. Are we ready to vote on that now? All those in favor of the motion as made, say aye.
Aye.
Okay, pass. Perfect. All right, 10:30. What's next on here? Financial we should address.
So if I could, I guess, I assume at this point, what we'll do is, we'll update the policy statement. These are our targets, update our performance report. And then are we next month having a conversation? Because this will cause some decent over underweights relative to the new target. We want to hold that discussion off for next month about actual any dollar changes. Correct.
I think so. We said we are separating the two decisions out. Yep. Well, this being implemented.
Let me go back.
This is
and ask-
long-term.
I feel like a broken record. The 5% that we want to take out of real estate, and we're saying we'll deal with it the next meeting.
Well, and I think practically some of that's illiquid anyway, so
Real estate is at 13, our actual real estate is at 13% right now.
And so that's kind of my questions is just for now, we'll talk about any dollar movements next month. There will be some options in terms of, rebalancing, requesting redemptions between managers moving to get closer to target, but we're all within ranges with the new policy.
When do we have, this is April, when will we receive our next repatriation of funds from our real estate managers?
I think for the most part, it's wrapped up.
Real estate's at 13% as the end of March. Have we received money since the end of March that would bring real estate
No.
down to 10?
No.
Then I don't understand your comment.
Well, and I'll have to pull back when it was, but we either got all our money back or we rescinded our notification because we had requested, I think, was it 10 million initially? But that was closer in 22 from Reef. And we started to receive all the value. I don't believe we have any still redemptions coming from them.
We have in your March report, maybe I misread it, but in your March report, our actual allocation to real estate is 13%.
Correct.
So I thought we had already passed I guess we didn't actually pass it because we talked about moving it down to 10.
We talked about moving it down to 10, but there's no redemption request in at the moment.
Then we have to submit a redemption request.
Right, so this was kind of my question about, there's things we could do, including this, including Acadian on the EM side, that now that we've adopted the policy are overweight. And my question was, do we want to put any of that in motion before next month?
Yes, you want to do the real estate immediately, although it doesn't really make any difference because they only need 15 day, I guess they need 45 days notice.
Can I suggest something?
Yes.
If you don't agree. So whatever we haven't done any major tweaks to our allocation, right? We are 99% the same. Given that, where we are pulling money out of, can't we just park it in the money market fund and let them do their job till we go to the asset allocation next month? Not add anything.
Excuse me, we have to get the money back from real estate to get
Part
down,
of that, I'm
but we're
including
not going to
that.
get that back until July.
So I'm saying, so we go ahead. Don't stop that is what I'm saying. Let them go ahead.
I agree, but we have to tell them to submit a redemption request to bring that real estate allocation down to about 10%.
Yes,
And that's what we're telling you to do.
that's what you told me to do. And so even more nuanced. So we've kind of what was approved, we 5% targets, what we call core real estate, 5 to value add. We're reducing our core real estate down from 10 to 5. So that brings it 15 to 10. We have 2 core real estate managers. So we've Reef and Heitman. And so we kind of have options. We can just eliminate one of them. Or we can keep both and just pull from both to kind of cut them both in half, if that makes sense.
For right now, why don't you just trim them, per rata?
So trim both,
Trim both, yes, and I have to keep repeating myself. Trim them both, per rata,
pro rata to get down to the target of 10%.
correct. Okay, but we won't get that money until July.
Correct. So that won't be coming by next month, but we can get it started.
In the meantime, issue, do we, to bring our equity down? To bring our international equity allocation up from 40 to 45? Do we want to reduce our domestic equity allocation now, which would then be refunded when we get the real estate money in July? Is that not reasonable?
That's what I was saying, it's
Yeah.
like liquidate it and park it in money market. Or short treasuries or something.
Well, that's a different thing, but yes, I accept your point. It's a different thing.
What is it? Can I, I'm sorry, just
Please.
connecting that conversation, it's if what we just approved, right this second, we're overweight our US target.
Mhm.
We just want to trim back to today's target and leave that money in cash until next meeting.
I mean, who knows what happens with the.
Yeah, I know, I don't know.
I'm agnostic on that. I mean, long term, yes, you know, I'm agnostic, whatever you guys decide. If you want to take it out now, you're gonna wait till next meeting and then take it out. Who knows what will happen in the
Yeah.
next 50.
I think that is the question.
We also have to get some, this is, we also have to get notice. So if we want to do anything with the domestic allocation, we ought to give notice now rather than run out of time next month. Correct?
You have to think about that.
Yeah, so you come like, we have to give notice to our managers to pull the cash out, yes. US, you know, can get it within a couple of days, international is monthly liquid across the board. But we won't be pulling from those guys.
The US money, we can get, when is the date for submission? For a request for funds?
They're all daily liquid, I mean, it's.
Marvelous. So, okay, so we can proceed with that now and increase our international, correct?
Yes, as long as to exist for all the managers we have in place, yeah. Those would be funded, we would line it up to be out of the market as least as possible. International managers, we'll say the 17th. We wanted to this month, it shouldn't be a problem. They need the money a few days before month end.
So we can, if we wanted to, we could rebalance domestic and international equities this month if we wanted to, correct?
If you wanted to, correct.
All right.
Wasn't,
Now, I'm sorry, Pepe?
wasn't one of the discussions we were having about changing or adding another international
Manager,
manager?
yeah, but not the allocation.
Right.
Right, but all I'm saying is, if we're changing the allocation and 100%, and we move 100% of it to be with the existing manager, and then we turn around next month and decide to add a manager, what is that?
I understand. To be fair to the committee, I'm already committed as to what I want to do with international large cap. Because I was responsible for hiring Silchester, because I've had a lot of experience with them since 2005. The people I had experience with aren't there anymore, and they've lost something. I'm on the investment committee of the Archdiocese. We terminated Silchester there in favor of Causeway. Causeway was the other manager we were considering here. And I should have asked Jason to just do both Silchester and Causeway, but I went with Silchester, which I wish I had not done. However, to be fair to the board, I'd like to have Causeway come in and give a presentation to the board as to what they do and how they do it, so we can understand what we would be investing in vis-a-vis Silchester.
So then When,
So the earliest we would do Causeway as a practical matter, the very earliest would be at the end of, matter of fact, the very earliest would be, this is what, April? The very earliest would be in June.
so all I'm saying is, when we reduce the US equity and we get a clump of money, rather than handing that all to Silchester to increase the international, put it in a money market fund or something to tide us over until we see Causeway, because then we may decide we want that money to go to Causeway.
That seems to be a
Does that make
reasonable
sense?
thing to do.
I'm just trying to avoid having us
Yeah.
give it all to Silchester and have to sell it, and then have to take it back and have them sell something.
That is a reasonable thing to
To
do.
further that thought, if we are considering a passive strategy for international, which is
That would
what
be-
I would like to do.
Matter of fact, we ought to look at both.
So I would like them to bring a couple of options for the passive, if that is the correct process. And we can, like, again, I'm agnostic over what happens, whether this happens next meeting. It can all be done in one, where we take this 5% and put it to that passive manager, which is what I would prefer.
Agree. You mentioned a couple of options. I'm just wondering, are there, I know there are a lot of different passive vehicles out there, but isn't the EPA index the least expensive one?
So it depends, right?
Either the
So, I
ETF or
mean,
Vanguard?
it depends on what, is your universe completely open? Or are we going to suggest, are we going to suggest?
I was just curious. They're gonna have.
No, we'll suggest, we won't have that many options. And for passive, it's kind of cut and dry. We'll look at, and there is difference between, do you want Acquiesce US and EFA, and we can certainly talk about that. But ultimately, from an implementation, it's pretty straightforward. It's kind of, there's some couple big players who match either index well and who's the cheapest.
Yeah, Vanguard, whoever,
Yeah, yeah.
you know, I mean, there are 4 or 5 different, very good options with three, you know, in 10 basis points, 15 bips, we can do it, you know.
Yeah, I was thinking just the Vanguard EPA index.
Yeah,
Maybe others which are even less expensive,
Yeah.
as
So, you know,
long as they do the job properly.
international, actually, you know, with all this tariff conversation we've been having, actually international, especially Europe, is up. It's not down like Europe, in US. Okay, so if valuation was not part of it, if it was all tariff, then we'd all be down. So valuation is playing in. So I would say, let's look at what the options are and then have that discussion and park it. I'm okay with that. If you guys feel like, let's take it out now and wait, I'm fine with that too. But I don't want to allocate to one of the international managers is what I'm, to be clear, is what I'm saying.
I understand what you're buying, so that's fine. And we'll look at Causeway vis-a-vis the passive vehicle at the May meeting. That's what I was saying. And we'll decide then. And it may be passive or it may be Causeway, but I'd like to have the board hear, and I'd like to hear directly from Causeway as well. All right?
So
So,
it's what we're saying, we want to reduce the US domestic now
And leave it in cash.
And
leave it in cash,
Yes,
and then we'll deal with the international part of it at the next meeting. Okay, that's, and be clear what we were talking about.
well,
that is my understanding.
I think we really practically we have to reduce the US, but we'd have to. No, I think that's.
well, so keep in mind, private equity is part of our target, but it's not fully funded up yet.
Yeah.
So where do you keep that allocation? And so I'm just looking, this is our March performance. So our new target to large cap is 24.
What page are you on?
I'm on page 42. So our, what you guys can say?
What is your point?
My point is, Milt, so our new target to us large cap is 24% of the portfolio. Small cap is 7%, so there's an overweight there, about 1.4%. But also private equity at the bottom is 6%, and there's a 1.4 underweight. So actually, those two really kind of match each other off. So really, the new dollars to international will come from our real estate redemptions,
Okay,
which again, we will put in redemptions for both Reef and Heitman to get us down to 10% real estate, but we won't necessarily have those dollars for a while. So I just want to make sure we're clear on expectations that there's really not money to pull out unless you guys direct otherwise from US at the moment. That'll be coming with the real estate redemptions.
We don't have any international exposure in the real estate, ones, right? That's domestic, 100% domestic, right?
Mhm.
And you don't have an international exposure, not to throw a wrench in it, not trying to make it complicated, just asking. You don't have an international,
Do we have international managers that do real estate? Yeah, there's some options there.
so just for something to think about, not right now, if the dollar weakens, which is what, in my
Mm.
opinion, a very, definitely
It seems to be highway.
very,
traffic.
very done deal. The two things that should perform, if we just talk about performance, is banks, international banks, and real estate, international real estate. Those are the two areas that will perform. You can read about it, you can sit with it, and then we can come back to the next meeting.
Anything else? Okay, you line up Causeway?
Yes, Causeway's already known, so they'll be here in May.
You've already done that, actually.
Yeah, we've done that. We'll bring back options on international. And really, just again, we can talk about the AcquiXUS versus EFA costs.
When do we expect our next call from our private equity managers?
Probably sometime in the second quarter here. I mean, they usually call it on a quarterly basis. So we do, I think later this year, we will probably want to make another commitment to private equity. And so we can talk about that maybe this summer after the Causeway visit.
In fact, we ought to consider somewhat higher allocation of private equity. I would like for us to do that, but that's not for this particular meeting. Anything else at this point? Okay, what else do we have on the agenda? By the way, at the next meeting, we will also go into closed session to finish off our discussions on the ordinance. And Paul will be here. He'll have the new mortality tables, and that will be the new information. And then the new mortality tables are likely to say we're further underfunded than we are right now, which is actually a good thing. We're living longer. That's supposedly a good thing. Alrighty?
So for me, we'll have the Silchester Causeway, which it sounds like we want to go through that, or do we want to? And we have the performance report. Just not sure how much time everyone has and what you want to cover. You let me know.
I don't need it. Well, it's almost 11. I would prefer, unless the board wants to, I would prefer not to go through the performance report because everything changed as of the end of March, very beginning of April. Or, yeah. I'm talking with the introduction of the quote unquote terraforms. Everything has changed. We don't know now what's going to happen. Whatever the performance was prior to that, it may be a very, very different trend line
Exactly.
over the next year or two.
Yeah.
All right, new business, any new business you would like to talk about now or put on the agenda for next month? Okay, we're open to questions from visitors, if there are any. And I don't know, Becky, who's actually there when it says attendees. Oh, Cyril with intelligence, whom I wish I knew what he did. FN News, and Marion. Marion, do you have any questions or comments? We're gonna get. Is she?
I've requested her to unmute, so if she were to
Okay.
have something.
Marion, you have to unmute.
There she goes.
Related to when you were going to take up the retirement ordinance, and you already alluded that you'll do that next month in closed session.
That would be in closed session, and it would be followed by, in the following month, in open session, of course.
Okay.
Okay, anything else, Marion?
Not at this time. It's.
All right, thank you. Hope you're all is well. All righty. Anything else, or are we ready to adjourn?
I move Luther.
Second.
All in favor?
Aye.
Thank you.